Hi, Assalamualaikum, and a very good day I wish to all of you. Welcome to our forum today. Let me introduce myself. My name is Nur Shazwina Aiza binti Kamaruzaman as a moderator for this forum. Today, we would like to highlight a topic that is quite interesting to be discussed on. What is the capital adequacy framework for Islamic Bank? I am sure that every one of us has own opinion on this topic. Before we start our forum, I would like to introduce our panelists today. Our first panel is Ms. Nur Aida binti Mat Zain. Next, our second panel is Muhammad Faizuddin bin Adnan. Before we start our forum in detail, let me explain a little bit about our topic today. For your information, capital adequacy is one of the most important indicators to assess the strength of banking operation. Without wasting time, let's hear the opinion about our title, What is a Capital Adequacy Framework from the first panel.
First of all, thanks to the moderator who asked the question. When we talk about capital, there is definitely a connection from a financial point of view, as well as the capital adequacy framework. What is meant by the capital adequacy framework? Capital adequacy framework is an approach to calculate the regulatory capital adequacy ratio and the level of that ratio required by a financial institution to continue to operate. The adequacy of regulatory capital is considered important to ensure that the risks of a financial position are known to ensure the ability of financial institutions to survive in any situation. This capital adequacy framework is established through international agreed standard on capital adequacy declared by the Basel Committee on Banking Supervision. The capital adequacy ratio serves to calculate CET1 capital ratio, Tier 1 capital ratio and total capital ratio. Financial institutions need to maintain at all times a minimum capital adequacy ratio of CET1 capital ratio at 4.5%, Tier 1 capital ratio at 60% and total capital ratio at 8%.
Thank you, Ms. Aida, for your explanation. Of course, the audience wondered, how about the capital adequacy framework for Islamic Bank? Can you explain more about this, Ms. Aida?
The capital adequacy framework for Islamic banking institution is a risk-weight asset to ensure that the measurement methodology is for the purpose of calculating risk-weight asset for credit risk, market risk, and operational risk. The framework is closely linked to the capital adequacy framework for Islamic banking institution, as it is a capital component and is the basis for the calculation of the capital adequacy ratio. The formulation of the framework is consistent with capital adequacy standard for institutions other than insurance institutions that only offer Islamic financial service issued by the Islamic Financial Service Authority and Capital Adequacy Frameworks Basel II risk-weight asset issued by the bank to banking institution licensed under Finance Service Act 2013.
Thank you, Ms. Aida, for your explanation. The important point that I get is the capital adequacy framework is an approach to calculating the regulatory capital adequacy ratio. I feel more understanding after hearing the explanation from Ms. Aida. Okay, let's invite Mr. Faiz to give his opinion about capital adequacy in banking.
Thank you for the question. When a bank experiences significant and expected loss, it must rely on capital to absorb the loss before the harm in creditors. To make a bank more robust to loss, the Reserve Bank mandates bank to return a certain level of capital against the riskiness of their asset. The more capital a bank has, the more difficult condition it can tolerate before depositors are impaired. One of the most essential indications for determining the soundness of banking operation is capital sufficiency.
Mr. Faiz said that to assess the strength of banking operation, one of the most important indicators is capital adequacy. Earlier, Ms. Aida mentioned the capital adequacy framework, Basel II risk-weighted asset. So, I want to ask, what is the difference between Basel I, Basel II, and Basel III framework?
Basel I was introduced in July 1980 to provide a framework for addressing risk management from a bank capital adequacy perspective. The minimum of capital to risk-weighted asset of 8% was implemented in 1992. In Basel I, general provisions were included in the calculation of the requirement minimum capital, while Basel II is to replace the minimum capital requirement with the requirement to conduct a supervisory review of the bank capital adequacy. The three pillars of Basel II that everyone should know are minimum capital requirement, the supervisory review process, and enhanced market discipline throughout this whole requirement. In contrast, Basel III aims to define an additional layer of common equity capital conservation buffer for banks. Basel III includes liquidity risk in addition to the risks introduced by Basel II. For predictability of future risk, Basel III is forward-looking as macroeconomic environmental factors are considered in addition to the individual bank criteria.
So, as a result of explanation from Ms. Aida, we know the difference between the three base framework. Next, I want to ask a question to Mr. Faiz. In your opinion, what is bank capital adequacy?
Capital is a residual item in bank balance sheet that is computed as the difference between asset and other liability with more senior period claims on the bank income stream and in the event of collapse asset. It reflects the bank's owner claim on the firm net asset and it serves as buffer to absorb change in the value of asset such as loan default or stock price fluctuation and liabilities.
Thank you, Mr. Faiz. As we all know, in order to better ensure the stability of the global financial and economic system, the capital adequacy of banks is tightly controlled around the world. Next, can Ms. Aida explain to the audience how capital adequacy is measured?
To calculate the capital adequacy ratio is to use Tier 1 capital plus Tier 2 capital divide risk-weighted asset. If the bank has a high capital adequacy ratio, it is considered healthy and in good standing to meet its financial obligation. The total minimum capital to risk-weighted asset ratio is 8% under Basel II and 10.5% under Basel III. The minimum capital adequacy ratio is important in ensuring that banks have sufficient cash cushion to absorb a reasonable amount of losses before they go bankrupt and lose depositor funds.
Thus, to exist the minimum requirement required to recommend solvency, bank required a high capital adequacy ratio. Therefore, if a bank has higher capital adequacy ratio, it is more likely to withstand a financial recession or others unforeseen losses. Next, Mr. Faiz, what are the new capital adequacy guidelines?
The Basel Committee on Banking Supervision has resolved to replace the 1988 Accord with a new capital adequacy framework, International Convergence of the Capital Measurement and Capital Standard, July 1988. It is divided into three categories or pillars, which are mutually reinforcing minimum capital requirement, supervisory review, and market discipline. The first pillar examines how minimum capital needs are calculated, as well as the technical challenges that contribute to capital adequacy requirement. The second pillar outlines crucial guidelines to guarantee that the supervisory process runs well. The third pillar examines the minimal disclosure criteria that must be made in order to improve the market discipline.
Thank you, Mr. Faiz. That was a great point to be said. Let's move to Ms. Aida. Can we know what is the purpose capital adequacy regulation for Islamic banks?
It's a good question to ask. Based on what I understand, there are several recommendations of capital adequacy rules for Islamic bank, but I only provide one recommendation that can be used to formulate more appropriate capital rules for Islamic bank. Most important is the criticism of AAOIFI approach. What is the criticism mean? First, the existing capital adequacy ratio developed by AAOIFI are only designed to ensure a certain level of solvency and ignore the agency role performed by Islamic Bank and principle involved. Second, there is inconsistency in defining limited investment deposit. Deposit should not be recognized as a liability of an Islamic bank and should not be included in the bank's statement of financial position. This is because depositors are also involved in making investment decisions. Third, the possibility of a bank facing an abnormal risk that arises in a management dispute, the depositor assumes that the bank has breached the agreed contract should be seen as a legal risk, which ideally require a case-by-case approach to be taken depending on the term used in the contract. Banks should be able to identify the difference between deposit taken based on pure PLS and those representing hybrid contract. Deposit with any potential claims party should be classified as hybrid-based deposit.
Thank you, Miss Aida, for your opinion. Okay, now let's move to Mr. Faiz to give his opinion about the importance of capital adequacy for Islamic Bank.
Nice question, moderator. A healthy capital adequacy is critical to a financial institution profitability and ensure that it will withstand any future financial crisis and may be helpful to policymaker and decision maker in Islamic banking business. First, the finding of the study might be used by financial regulators such as central banks to give a guidance and on appropriate capital level for local banks in terms of rules, deregulation, and financial disruption. Second, the Islamic banking sector practice implication will then offer them insight into how a bank capital affects its profitability. As a result, management may work toward achieving an ideal structure that enhances their performance while also recognizing excellent or bad capitalism practice.
Thank you, Mr. Faiz. That is a good explanation. Miss Aida, in your opinion, what are the challenges in implementing capital adequacy guideline to Islamic Bank?
When it comes to finance, there are definitely challenges to be faced. Similarly, the challenge in implementing capital adequacy guideline for Islamic banks, in my opinion, the challenge is that Islamic banking activity differs in substance and form from conventional banking operation, and thus they face different risk profile. As I described earlier, Basel II consists of three risks, namely credit risk, market risk, and operational risk in conventional banks. For Islamic banks, it has similarity in terms of risk with conventional banks but has differences in terms of rate of return risk, dispersed commercial risk, price risk, and others. This clearly indicate difference in performance of risk faced by financial institutions. When we look at it in terms of price risk, Islamic banks need to own different assets before they can sell them to customers who need financing. To comply with Sharia rule, who cannot sell what they do not own. But when conventional banks acquire a commodity for trading purpose, that are exposed to price risk or market risk.
Thank you, Miss Aida. So, as the result from this forum, we can conclude that the capital adequacy play an important role in order to determine bank activity. In addition, the bank need to ensure that it holds a minimum level of capital to ensure adequate funds to cover unforeseen losses. Finally, we had reached the end of our forum. Thank you to all our panelists today. A lot of knowledge has been shared by our panel. There is also knowledge that we did not even know or think about before. Well, from what all our panelists shared just now about our topic is the capital adequacy framework for Islamic Bank. That's all for today. I will end our forum discussion with thanks to all our panelists and audience for your cooperation. Thank you and Assalamualaikum.